I'm here with Will Main. Q3 has been an interesting quarter throughout the Asian region. What have been some of the highlights?
Well, it was another strong quarter for the region in markets, building on the significant gains seen in the prior quarter. Economies around the region remain in recovery mode, rebounding from the national lockdowns imposed by governments earlier in the year. What is perplexing at this point in the cycle is the narrowness of market returns. Essentially, there are a number of very large cap stocks driving overall markets higher. As you can see from the chart, less than 30% of stocks have outperformed the overall market, well below the longer term average. As the economic recovery continues, we expect this narrow cohort to widen significantly.
You've also been through reporting season. What has surprised you?
The overall message from reporting season was that it was better than feared, with management teams pointing to improving incremental demand as well as a better second half outlook. As you can see from the chart, earnings in 2020 have now stabilised, and at the margin, revisions have turned positive for the first time in 2020. For the remainder of the year, we'll be looking for further clarity around bank non-performing loans, as well as more signs of the cyclical bounce in earnings.
There appear to be a two-speed recovery across the region. Any comments from a geographical or sector perspective?
The impact from COVID-19 has been far from uniform across countries and sectors. Generally, North Asian countries have performed better than their ASEAN counterparts, who have also suffered from secondary lockdowns as their healthcare systems struggle to cope with the pandemic. Those ASEAN markets also don't contain a lot of technology, which has been one of the better performing sectors as they benefit from the stay-at-home, work-from-home thematic. Many tourism-related sectors have also lagged the recovery significantly. We don't think that demand has been permanently impaired for these products and services, but we do realise that the recovery will take longer as we look beyond 2020.
Value has underperformed the broader market. What scope is there for a change in leadership?
Undoubtedly, COVID-19 has created headwinds for value in 2020. Given that the more cyclical and cheaper parts of the market have seen earnings downgrades and the more expensive or growth-oriented parts have seen a re-rating of earnings, relative valuations between the two cohorts now sit at close to 20-year highs. History tells us that this dynamic is unlikely to last, and while the timing can never be certain, we think that given where investor positioning is within the market, value has a long way to run, both from an earnings perspective as well as a re-rating perspective.
Even though the Asian region has performed strongly recently, why, in your view, should investors continue to maintain their exposure?
The case for Asia remains centred on cheap starting valuations, ongoing earnings growth, and a rising dividend yield story that are set to play out over the coming years. We think that Asia as an investment destination has been overlooked by investors, despite having a number of world-class companies with long runways of growth leveraged to rising incomes. Asia has held up well relative to developed markets, and we see this as a positive sign as investors re-examine its prospects in a more favourable light. Despite the ructions of COVID-19 that have taken place this year, we think that the upside for Asia is likely to continue for the foreseeable future.
I think that's clearly evident, Will, in the number of institutional asset searches that are going on for the region. So we remained pleasantly buoyed by the activity.